Reaching the $11,000 point in monthly dividend income is an exciting milestone. Will it allow you to retire as funds are being deposited into your account for doing nothing? Most likely not, but with the accelerating interest and compounding effect you might get there sooner than you'd think. $11,000 is enough where it can have a noticeable impact on your finances, and you'll be happy seeing your investment start producing this much income. Once your account becomes this large, you'll likely become more dedicated to growing that account to where you can live your dream lifestyle and retire. How much money do you need invested to safely generate this much income? Let's take a look at some different scenarios and you can see just how much money you need to earn $11,000 per month in dividends. Stay to the end to learn how to decide the best option for you. My name is Chris and I help teach people about money, personal finance and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Your first step to earning $11,000 per month is choosing a desired dividend yield. This isn't supposed to be the highest yield you can possibly find, but the proper amount of growth, income and stability to suit your situation. It can be confusing to hear people talk about receiving dividends from a stock that yields 2, 3 or 5% when you could just purchase a stock yielding 12% and earn much more money. The fact is, buying something with an incredibly high dividend yield can be risky. For example, the price could be in decline or the dividends could be at risk. This is often the case with an individual stock or even a sector-specific fund. Reasonable dividend yields can start out at just 0.5% and up to a sustainable 5%, so plan on achieving something in that range. On the surface, the higher the yield the better. The mistake investors commonly make is by purchasing assets with unreasonably high dividend yields. There are two situations where this could be a problem. In the first situation, high yield could indicate a company with slow growth prospects, so the market demands a higher yield. This is because there will be little in the way of stock appreciation. This is the same idea when it comes to an entire sector, as the market prices sectors in regards to future growth, risk and other factors. An example of a company like this is the tobacco company Altria. This stock has risen and fallen for years, currently priced the same as it was in 2014. To mitigate this relatively flat stock price, the dividend yield is around 8%. This is essentially investors seeking an 8% dividend in exchange for little growth in share price. Looking at an entire sector like oil and gas, the dividends are higher than others because some investors are foreseeing a decline in oil demand at some point in the future. The second high yield situation is a little more concerning, and that's because the dividend isn't safe. An unsafe dividend means the company might reduce or suspend its dividend in the future due to poor business performance. These are the types of companies to avoid. So it's important to do your research. A slash dividend almost always results in a dropping stock price. However, investors might sell the stock beforehand as a SL dividend is anticipated, resulting in a low stock price in dividend that is still high. This could be the same with an entire part of the market, with retail for example. For someone who wants a hands-off approach, purchasing a dividend ETF like Schwab's CHD, which is very popular and well liked among dividend investors, can work nicely. This fund matches the return of the Dow Jones U.S. Dividend 100 Index, which holds companies like the Home Depot, Texas Instruments and BlackRock. By putting your money into this, you receive a stable 3% yield with a reasonable amount of growth to ensure the value of your investment rises over time. With a 3% dividend yield, you need to purchase about $400,000 worth of this stock in order to generate $112,000 per year or $1,000 per month on average. It's a high-quality option that holds blue-chip companies that are likely to continue paying and increasing their dividends over time. But if you're looking to make the most money over a long period of time, another option might be best. VUG is Vanguard's growth ETF, which is perfect for investors who aren't concerned about dividends and just want to receive higher overall returns. This fund tracks the CRSP Large Cap Growth Index, which grows quickly on average. This is because the largest holdings are Apple, Microsoft and Alphabet. They're all large established companies, but the dividends they pay are minimal, with a yield of just 44%. This means you'd need almost a whopping $2,750,000 just to earn $1,000 per month in dividends. While that seems like a paltry amount of dividends for that much capital, consider that the growth alone outpaces what you'd leisurely receive in both dividends and growth with a dividend fund. In other words, even with dividends reinvested, you'd usually be better off with a quality growth fund like this. Perhaps the best mixture of growth in dividends is by purchasing the market or a fund that tracks the S&P 500. By doing this, you receive an average amount of income with an average amount of growth. This is one of the best options for someone who doesn't want to think too much about their investing strategy and wants a somewhat balanced portfolio. Purchasing a fund such as VO or the Vanguard S&P 500 ETF would provide exposure to a wide variety of companies. You'd own Apple, Microsoft, and Google in addition to companies like JP Morgan Chase and Johnson & Johnson. The dividend yield is average since you're buying the market at 1.31%. In order to bring in $1,000 per month, you'd need roughly $920,000 invested. Still a lot, but significantly less money is needed than a more aggressive growth fund. You can receive high dividends and more diversification than you would from a single stock by purchasing a sector-specific fund. This would be a fund dedicated to a certain sector such as real estate, financials, industrials, utilities, and so on. By taking a look at different options, you can find some that pay higher dividends than others. If you're bullish in one of those sectors, it could be a buying opportunity. However, there's usually a reason or many reasons that a sector has a high yield, and it's important to understand why the dividends are higher and assess the risk. Vanguard's Energy ETF VDE has a high dividend yield of around 3.5% due to the additional risks associated with the sector. You need about $350,000 invested to earn $1,000 per month on average. However, in early 2020, the energy sector was trading at a huge discount relative to other sectors and presented an opportunity for growth and dividends for those understanding of its risks and potential reward. The riskiest and least predictable option is purchasing individual dividend stocks. You might achieve a higher yield and you might even achieve higher growth. In the case of Altria, you'd only need $150,000 to earn $1,000 per month in dividends. Keep in mind that the future of the stock price is less predictable than buying something with more diversification. Although buying Altria at the right time could have been very profitable with a mixture of growth and income, for others they lost money chasing a high yield. Knowing the different options in their pros and cons, which direction should you go? A strategy investors commonly use is focusing on growth early on in their investment career. This is the time when your primary concern is achieving your growth. When you're in your 20s, 30s, and even 40s, dividend income is irrelevant unless you plan on retiring early. Young investors who focus solely on growth will usually have better annual returns than someone who is only concerned about dividend income. Even slightly better annual returns can make a huge difference over time. As you need retirement, paying more attention to dividends can be beneficial if you plan on living on those payments. As you age, you're less concerned with the annual growth and more concerned with income safety and capital preservation. When approached cautiously, a dividend investment strategy is safer and more stable than a higher risk growth strategy. The biggest consideration when deciding between growth and dividend investments is how long until you plan on retiring. When you're many years off from drawing on your investments, implementing a dividend investing strategy could cost you hundreds of thousands of dollars of lost potential interest. Although it's exciting for younger investors to think of dividends as entirely passive income, a rising share price is also passive income, just in another form.